In this video, we are going to talk about the Target stock. So before starting this video, please like this video and subscribe to this channel for our future updates. Target, NYSE, TGT, is frequently overlooked when discussing major retailers. Retail analysts have tended to focus on Target's main competitors, Walmart, Costco, and Amazon, particularly in light of the COVID-19 pandemic. Local governments, like its peers, deem Target essential, and it has continued to operate while several of its competitors have shut down. This has likely aided Target stock in recent months, as a surge in consumer staples has boosted revenue. Now that the stock has recovered from its March lows, investors must decide whether Target stock is still a buy. During the pandemic, profits plummeted. Target's earnings report in the previous quarter brought both bad and good news to the company, despite remaining open and benefiting from a consumer staples run. The pandemic has already had a positive impact on Target stock. It, like most other stocks, plummeted in late February and early March. During April and most of May, however, the stock price soared. Target had recovered to its February high by mid-May. The most recent earnings report appears to back up the optimism. The company's revenue increased by 11.3%. This includes an increase of 10.8% in comparable sales and a 141% increase in digital comparable sales. Unfortunately for the company, the cost of sales increased by 18.5% during the COVID-19 pandemic. The company's earnings for the quarter were 57 cents per share, thanks to increasing selling, general, and administrative expenses. The company earned $1.54 per share in the same quarter last year, which was down 63.3%. Target compares well to its peers. Despite the earnings decline, Target stock may be the best option among the major retail stocks. This is why. The dividend may cause some concern, given the company's profit in the first quarter fell short of the 66 cents per share quarterly payout. Fortunately, even with lower earning expectations, analysts anticipate Target to earn $5.28 per share this year, putting the firm in a strong position to cover the dividend. Furthermore, the current dividend yield is at 2.2%. This outperforms Walmart, Costco, and Amazon, which does not offer a payout. Furthermore, Target has a long history of increasing its dividend every year. Given the risk of losing its dividend aristocrat title, the firm will very certainly choose to preserve the payout increases if at all possible. Despite the pandemic, there are no evident challenges to the dividend. Investors should keep in mind that, despite initial difficulties in starting e-commerce, Target has figured out how to exploit its omni-channel edge. The 141% growth in digital comparable sales outpaced Walmart's 74% gain and Amazon's 26% increase. In addition, bankruptcy filings by peers in the garment industry, such as Neiman Marcus and J.C. Penney, could help raise sales even further. Despite its faster sales growth, Target is valued lower than many of its competitors. The Target stock is currently trading at around 27 times expected earnings. This is significantly higher than the 5-year average multiple of roughly 15. Despite this, both Costco and Amazon advocate for greater prices. While the multiple is slightly higher than Walmart's projected P/E ratio of roughly 25, when investors consider Walmart's slower growth rate, Target still compares favorably. Target still has room for expansion. Furthermore, the company's omni-channel capabilities are being expanded on a brick-and-mortar level as well. Target has moved to small-format stores for expansion, with 75% of the U.S. population residing within 10 miles of a Target store. This serves as a pickup point for online orders as well as those searching for quick shopping visits. Target will also be closer to the growing population of central cities, a demographic that Target has hitherto underserved. Furthermore, investors should not abandon overseas markets. Yes, Target Australia is unrelated to the same named retailer in the United States. Furthermore, investors may recall Target Canada's failure. Target's presence in all 50 states, however, may entail a second attempt to cross the border. If it can replicate its colleagues' success in other nations, the company's expansion might last decades. Taking a unique position in retail. As things return to normal in the post-pandemic world, Target's efficient one-stop shopping will continue to appeal to time-crunched shoppers seeking convenience and value. This distinguishes Target from smaller rivals and specialist retailers. With a well-established omni-channel strategy, the company also makes it as easy as possible for customers to shop at its outlets. Target takes advantage of its massive store presence, with almost 1,900 stores within 10 miles of the vast majority of U.S. consumers to offer the fastest and easiest digital fulfillment in retail, according to the company. That reach was crucial, as the firm generated 95% of its fourth quarter revenue from its stores, which included both in-store and online sales. In both good and bad economic times, consumers value unique, high-quality product options at reasonable rates, and Target excels in this market. Omni-channel and e-commerce will boost business. CEO Brian Cornell elaborated on Target's omni-channel capabilities by recounting a message from a Target shopper. Please continue to perform curbside pickup. It is extremely beneficial even outside of COVID. This is an excellent service, and it is for this reason that I will continue to shop at Target. In fiscal 2020, digital growth was substantial, with e-commerce sales increasing by $10 billion, boosted by a 235% increase in same-day services. Only by investing heavily in technology, the supply chain, and store operations has the company been able to achieve this level of success. Without these expenditures, we simply would not have been able to meet the rising guest demand for same-day services, as evidenced by a 600% increase in Drive Up, Cornell stated on the most recent earnings call. Last year, Target's acquisition of Shipt, a same-day delivery network, surged by more than 300%. Because of how conveniences like same-day delivery and Drive Up services influence buyer behavior, these expenditures are critical. Customers that utilize Drive Up for the first time spend roughly 30% more than they did before, and management has noticed a similar pattern with customers who use Shipt. Target has declared that it will invest roughly $4 billion per year in capital expenditures to develop its multi-channel capabilities, which will help the company grow sales by 4 times more than store-only shoppers and nearly 10 times more than digital-only shoppers. On the fourth quarter earnings call, CFO Michael Fidelki explained, "In each of the next few years, we expect yearly investment in the $4 billion range to support remodels, new stores, and supply chain projects that increase replenishment capacity and modernize the network, including sortation centers. We'll invest in Ulta Beauty Shop in shops and optimize front-end space in our busiest sites to improve the efficiency of our pickup and drive-up services, in addition to full store remodels. Brand launches and partnerships have been a hit. Target has had a lot of success with its private label items and brand partnerships. 6 in-house brands currently generate $1 billion or more in annual sales as part of the latter endeavor. Its All-in-Motion athleisure collection debuted in 2020 and reached the $1 billion mark by February 2021. This formula is still being used by the firm with its brand partners, as seen by the launch of exclusive Apple experiences in 17 stores earlier this year. Target has been working with Apple for over 15 years, but this new partnership will increase its footprint, with additional Apple product displays and more extensive accessory sales. Target's digital channels will soon feature a dedicated Apple landing page. On February 28, the retailer expanded an ongoing partnership with Levi Strauss & Co. by releasing an exclusive, limited edition home and lifestyle collection as part of its partnership with the denim brand, which began in 2011. This is Levi's first home collection, and it provides Target shoppers with even another unique offering of exclusive products. Target is in an excellent position to continue its run of top and bottom line growth from the previous year. Millions of customers have been won over by the company's formula, which combines a one-stop shop of well-curated, popular items with ultra-convenient fulfillment. The company can build on its recent momentum to gain market share in the long run. Look to the future. When compared to its main competitors, Target stock is a buy on both valuation and growth potential. Target appears to be a more profitable investment than Walmart, Costco, or Amazon for those looking to invest in the retail sector. It has a low multiple, and its revenue growth rates are higher than those of its direct competitors. Despite this, there are reasons for investors to be skeptical of Target stock. Its forward P/E ratio far surpasses historical averages, thanks to considerably lower earnings caused by the COVID-19 outbreak. The higher multiple that came with decreased earnings, on the other hand, may not endure. Analysts predict earnings of $6.91 per share for the fiscal year 2022. When divided by the current share price, the forward P/E ratio for 2022 is at 16.9. This is more in line with Target's 5-year average multiple. Target stock is a buy because of this, as well as a safe, rising dividend. What do you think about our video? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.